the Russian embassy in Nairobi floated the idea that, a gold-backed trade settlement currency would be on the agenda in Johannesburg. And it didn't make the cut. Why? China didn't want to if you like, upset the world, upset the entire fiat currency system by backing this. India certainly didn't want to do it. India is Keynesian to the core. The idea of going back onto a gold standard, if you like, would limit the Indian government's ability to manage its own economy very substantially. And not only that, but they've spent all their time trashing population for being gold friendly, because as far as I'm concerned, these were imports which were completely unnecessary, and without it, India would have had net exports, whatever. Basically they're anti-gold. They're now accumulating gold because they have to. And I think also the other thing which is actually important in terms of BRICS is that the BRICS membership, of course, they talk to each other a lot, at government level and also at central bank level. And I think they're generally agreed that the West's fiat currency system is on its last legs. And that's why these central banks are aggressively accumulating any gold that they can get their hands on. The FOMC statement yesterday, Powell, tried to sort of say, slow down on your ideas about cuts in interest rates in 2025. For goodness sake, I've been telling people that, bond yields are going to rise. Now, what the Fed does with that, is a separate question. But bond yields are going higher, and they're going to go a lot higher. And, we're beginning to see them break out on the upside again. Certainly, if you look at sterling rates, you've got a double whammy there because you look at the charts of the long gilts, and they are soaring. The yield is soaring, which means that the price is collapsing. And sterling is also in a very, very sickly position. That is going down south. And I think it won't be terribly long before we see it back down to, there'll be a bit of consolidation at 120 to the dollar, then 110. Then I really think, unless this government changes hugely, I think actually does lie in the Asian hegemons and the Shanghai Cooperation Organization and BRICS and so on and so forth. There is a whole world there which is actually larger than ours, certainly on a purchasing power parity basis and also in terms of population, which is going to thrive. You've got an industrial revolution which is happening throughout everybody associated with that, which is why so many countries want to be involved with it. But of course, at the same time, they're frightened of what we might do to them, like call in their debts or regime change or whatever how we traditionally manage these countries. So you can see that we're at a sort of bifurcation, if you like. The world is split very definitely into two, but it's going to be quieter on the BRICS side, I think, in 2025 than in 2024. There's a lot of noise going on about, a new trade-backed currency, and Russia had something like 220 meetings for BRICS countries and also those intending to join BRICS all around Russia. This is very, very active. So I think that's going to dampen down a bit now. In terms of other geopolitical factors, I think that we are looking at trade, which is now going to trade tariffs are going to be the big problem, I think, in 2025, assuming that Trump means what he says, that trade is the most beautiful word. And assuming that Scott Bessent, his nominated Treasury Secretary, doesn't actually sort of stamp on that. I think, this is actually another point. In the past, when you look at Smoot-Hawley, for example, Smoot-Hawley was passed by Congress, Senate, and then signed into law by President Hoover in early 1930.
The Federal Open Market Committee, FOMC statement, accompanied by Jerome Powell's comments, highlighted a growing tension in global financial markets. Powell's warning to slow down on expectations for interest rate cuts in 2025 was an attempt to temper market optimism. But the reality is this: bond yields are climbing, and they're poised to soar much higher. This trend reveals a profound shift in the financial landscape, one that could have cascading effects on global currencies, economies, and ultimately, the value of gold and silver. Looking at the UK as a case study, sterling's weakness is mirrored in the soaring yields on long-dated gilts. This means their prices are collapsing, reflecting dwindling investor confidence. Sterling is headed south, with potential consolidation around $1.10 to the dollar, possibly even lower. The broader context here is a global economy teetering on the edge of bifurcation. On one side, you have the traditional Western powers clinging to a faltering fiat system. On the other, emerging economic blocs like BRICS and the Shanghai Cooperation Organization, SCO, are quietly building momentum. This divide between East and West is no longer theoretical. It's materializing rapidly. The BRICS bloc, now encompassing a growing number of nations, represents a significant portion of the world's population and economic activity. These nations are laying the groundwork for an industrial revolution that could redefine global trade and finance. It's no wonder many countries are eager to join. Yet, these same nations are wary of the West's historical tactics, debt manipulation, regime changes, and economic sanctions. As we look to 2025, trade tariffs are likely to dominate the geopolitical narrative. Donald Trump's promise to enact 100% tariffs on BRICS nations pursuing de-dollarization has sparked widespread debate. Let's call it what it is: financial warfare disguised as trade policy. Such aggressive tactics are unlikely to deter the BRICS nations, which have been laying the groundwork for greater economic autonomy. These nations understand that their collective strength lies in diversifying away from the dollar and bolstering their gold reserves. To understand this dynamic, it's worth revisiting the historical parallels with the Smoot-Hawley Tariff Act of 1930. Back then, trade barriers exacerbated economic tensions, deepening the Great Depression. Today, Trump's tariff threats could similarly backfire, straining relations with China and Russia. Both nations are pivotal to the BRICS agenda and remain committed to reducing their reliance on Western financial systems. Take Russia, for example. While many commentators speculated that Moscow's proposals for a gold-backed trade settlement currency would gain immediate traction, the reality is more nuanced. At the 2023 BRICS summit in Johannesburg, this idea was shelved. Why? China and India, the bloc's largest economies, were reluctant to upend the global fiat system overnight. China, wary of disrupting its trade dominance, and India, deeply Keynesian in its economic approach, saw the proposal as premature. But shelving the idea doesn't mean abandoning it. Central banks across the BRICS nations continue to accumulate gold at record levels. This trend signals a long-term strategy to position gold as a cornerstone of a new financial architecture, one that challenges the West's fiat dominance. The growing consensus among BRICS central banks is that the Western fiat currency system is on borrowed time. This realization has driven aggressive gold acquisitions. Central banks understand that gold, as the world's only universally recognized Tier 1 asset alongside U.S. Treasuries, offers unparalleled stability. Unlike fiat currencies, gold cannot be printed at will. It is a finite resource, immune to the reckless monetary policies that have undermined confidence in traditional financial systems. China's role in this gold rush cannot be overstated. Despite being the world's largest gold producer, China remains a net importer of the metal. Why? Because the Chinese government and its central bank recognize gold's strategic importance. By steadily accumulating gold, China is insulating itself from potential dollar volatility while preparing for a future where gold-backed currencies may play a pivotal role. Alasdair Macleod's insights illuminate a world in transition. The bifurcation between East and West, the growing irrelevance of fiat currencies, and the resurgence of gold all point to a new economic order. For individual investors, the message is clear. The time to accumulate gold and silver is now. This is not about chasing short-term gains, but about securing long-term stability in an increasingly volatile world.
What you have is Trump basically shooting from the hip on tariffs. I mean, he's going to set the tone, I think, a lot more than the sort of, if you like, the elected politicians. So on that basis, we're going to see, I think, relations between China and America deteriorating. I think when it comes to Russia, there is not going to be an easy solution there, as Trump has told us. I think quite a lot of commentators sort of took the view that Russia would immediately change everything and bring in this, that, and the other thing, and we notice huge differences. I think the principal difference, and this is something which obviously, was practical, was instead of trying to integrate a whole new raft of BRICS members, they created an associate membership category, which allows potential members, if you like, people who have expressed an interest in becoming part of BRICS, to, if you like, go into a sort of waiting room while, the integration process for them develops. And this is something which isn't necessarily immediate. I mean, it could take several years. Also, that they were going to immediately do away with the dollar. No, that's going to be a long, long process. I mean, it's an evolutionary process, if you like. That the Russians could sort of suddenly change this, I think was actually stopped in 2023 when the Russian embassy in Nairobi floated the idea that, a gold-backed trade settlement currency would be on the agenda in Johannesburg. And it didn't make the cut. Why? China didn't want to if you like, upset the world, upset the entire fiat currency system by backing this. India certainly didn't want to do it. India is Keynesian to the core. So the idea of going back onto a gold standard, if you like, would limit the Indian government's ability to manage its own economy very substantially. And not only that, but I mean, they've spent all their time trashing population for being gold friendly, because as far as I'm concerned, these were imports which were completely unnecessary. And without it, India would have had net exports, whatever, I mean, basically they're anti-gold. They're now accumulating gold because they have to. And I think also the other thing which is actually important in terms of BRICS is that the BRICS membership, of course, they talk to each other a lot, at government level and also at central bank level. And I think they're generally agreed that the West's fiat currency system is on its last legs. And that's why these central banks are aggressively accumulating any gold that they can get their hands on.
The global financial landscape is undergoing a seismic shift, with gold and silver emerging as the linchpins of a new economic order. While Western nations grapple with mounting debt and faltering fiat currencies, the BRICS bloc and its allies are strategically positioning themselves for a future defined by monetary stability and multipolarity. Let's dive into the dynamics that make gold and silver indispensable in this transformation. Debt is the Achilles heel of the Western economic model. The staggering levels of government debt across the US, UK, and Europe have reached unsustainable proportions. In the US alone, the national debt has soared past $36 trillion, a figure so astronomical that it defies comprehension. Servicing this debt requires the constant issuance of treasury securities, but with traditional buyers like China and Russia stepping back, the bond market is growing increasingly precarious. Bond yields are rising, reflecting the market's skepticism about the solvency of Western governments. In the UK, for instance, long-dated gilts are experiencing a collapse in prices, pushing yields to levels not seen in decades. Sterling, meanwhile, continues to weaken, further eroding investor confidence. These developments are not isolated. They are symptomatic of a broader loss of faith in fiat currencies. As Alasdair Macleod points out, the real driver behind rising gold prices is not gold appreciating, but fiat currencies depreciating. This distinction is crucial. The nominal price of gold is merely a reflection of the declining purchasing power of paper money. When the general public finally grasps this reality, that their currencies are losing value, the rush into gold will accelerate, pushing fiat currencies even lower. The BRICS nations, Brazil, Russia, India, China, and South Africa, are at the forefront of this monetary revolution. Collectively, they represent a significant portion of global GDP and population, giving them the leverage to challenge the Western-centric financial system. While the idea of a gold-backed BRICS currency remains in its infancy, the bloc's actions speak louder than words. Central banks across the BRICS nations are hoarding gold at unprecedented levels, signaling their intent to reduce reliance on the US dollar. China's role is particularly noteworthy. As the world's largest producer and importer of gold, China is methodically building its reserves. This strategy is not merely about diversification, it is about preparing for a post-dollar world. By accumulating gold, China is insulating itself from the dollar's volatility, while positioning the yuan as a credible alternative in international trade. Russia, too, has been a vocal advocate for gold's role in the global economy. Despite Western sanctions, Russia has continued to stockpile gold, viewing it as a hedge against geopolitical and economic uncertainty. The country's central bank has been instrumental in pushing the BRICS agenda, advocating for greater economic cooperation and reduced reliance on Western financial institutions. One of the most significant developments in recent years has been the reclassification of gold as a Tier 1 reserve asset by the Bank for International Settlements, BIS. This change elevates gold to the same status as U.S. Treasuries and cash, reinforcing its role as a cornerstone of financial stability. Central banks have taken note, with gold purchases hitting record highs. The implications of this shift are profound. By holding gold as a Tier 1 asset, central banks can offset liabilities on their balance sheets, strengthening their financial positions. This is particularly important for nations looking to distance themselves from the U.S.-dominated financial system. Gold provides a level of autonomy that fiat currencies cannot match, making it an essential tool in the arsenal of countries seeking monetary sovereignty. While gold often steals the spotlight, silver deserves equal attention. Often referred to as gold's little brother, silver offers unique advantages as both a monetary metal and an industrial commodity. The gold-to-silver ratio, currently around 85:1, is historically high, suggesting that silver is significantly undervalued relative to gold. As gold prices rise, silver is expected to outperform, narrowing this ratio and delivering substantial gains to investors. Silver's industrial applications add another layer of value. From solar panels to electric vehicles, silver is indispensable in the green energy transition. This dual role as a monetary metal and industrial powerhouse makes silver an attractive investment in a world increasingly focused on sustainability. Investors seeking exposure to gold and silver should not overlook the mining sector. Despite the rising prices of precious metals, mining stocks remain deeply undervalued. This disconnect between the price of metals and the valuation of mining companies presents a compelling investment opportunity. Institutional interest in mining stocks has been tepid at best, largely due to misconceptions about the sector. Many view mining as a dirty industry plagued by environmental concerns and operational challenges. However, this narrative is changing. As fiat currencies lose value and gold and silver prices rise, institutional investors will inevitably turn to mining stocks as a way to gain leveraged exposure to precious metals. The realignment of global finance has far-reaching geopolitical implications. The growing influence of the BRICS bloc challenges the West's dominance, creating a more multipolar world. This shift is not without its challenges. Trade tensions between the U.S. and China are likely to escalate, with tariffs and sanctions becoming tools of economic warfare. At the same time, the West must grapple with its own internal contradictions. The reliance on debt-fueled growth is unsustainable, and the cracks are beginning to show. As central banks print money to service growing debts, the risk of hyperinflation looms large. Gold and silver offer a lifeline in this environment, providing a hedge against currency devaluation and economic instability. For investors, this global pivot toward gold represents a significant opportunity, particularly in the mining sector. Despite rising gold prices, mining stocks remain undervalued. The reasons are manifold: a lack of institutional interest, outdated perceptions of mining as a dirty industry, and the sector's long-standing underperformance. Yet, as fiat currencies weaken, institutional investors will inevitably seek refuge in tangible assets like gold. When this happens, the mining sector could witness an unprecedented influx of capital. The mining industry's current undervaluation is a classic case of market inefficiency. Consider the gold-to-silver ratio, which hovers around 85:1. This ratio is historically unsustainable. As gold prices rise, silver, often referred to as gold on steroids, is likely to outpace gold in percentage terms. This dynamic creates a unique opportunity for investors willing to bet on silver mining stocks, which offer leveraged exposure to rising silver prices. As we navigate the complexities of a fragmented world, gold and silver emerge as beacons of stability. The bifurcation between East and West, the unsustainable debt levels in the West, and the strategic actions of the BRICS nations all point to a future where precious metals play a central role in global finance. For individual investors, the message is clear. Accumulate gold and silver while you can. This is not about speculation. It is about preserving wealth in an era of uncertainty. Whether through physical holdings, mining stocks, or ETFs, with caution, the time to act is now. The transition to a new economic order will be turbulent, but those who position themselves wisely will emerge stronger. Gold and silver are not relics of the past. They are the foundation of the future. As Alasdair Macleod aptly observes, understanding the relationship between money and credit is essential. In a world awash with fiat currencies, gold and silver are the ultimate forms of real money.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.